Hey everybody, this is Dr. Tom Carr, aka Dr. Stoxx of drstoxx.com. That's drstoxx.com. We have been in business every market day since October of 2002, if you can believe it, publishing daily, weekly market letters and how to trade webinars, how to read charts, trading system manuals, and count them, two live trading rooms over in Discord. One is aimed at stocks and exchange traded funds and micro e-minis, kind of a jack of all trades. And the other one focuses exclusively on options. And if you want to join both, you can do that at a deep discount. All right, let's get down and look at the market. First thing I want to do is go over to FinViz, our one-stop shop for all things trading. And you can see today's market is a bit on the choppy side. So it started a little bit on the upside, then it went to the downside, then it went back to the upside, and then again to the downside, and then back to the upside. It's stop this roller coaster. I'm getting queasy. All right, but it is a consolidation day. No big surprise. We're doing some back and fill, some consolidation, some testing of levels on an intraday basis. Because yesterday, Monday, the 24th of March, was an amazing upside day. It was the only kind of day, however, that the only way to really profit from yesterday's big move was to be long the day before, which is to say the Friday before. And fortunately, we were. So we had on and have on a set of long-term positions in some of the mags, in Bitcoin, in bonds, and a variety of other things. That all, except for bonds yesterday, but everything else did really, really well. We were up over 4% just on one day in that portfolio. And that's one of the reasons why we put that on is that we know, everybody knows that one of the big secrets of the market is that most of the price movement happens overnight, not during the trading day. Trading days tend to be pretty tight in a range basis. Not always, but tend to be pretty tight. And all the big action takes place. Most of the big action takes place overnight. So if you have positions on longer term, you're going to take advantage of that. You can capture that move. If not, if you're a day trader, of course, you can make a very good living day trading, but your range is much tighter. And so you have to go really drill down to the 1 minute, 2 minute, 3 minute charts for that. All right, so the wealth building portfolio, that's the name of our long-term portfolio. It's been doing really well. We've closed over 90 trades. We are banking on 90% of them. And yeah, we've got a whole new set on after this recovery, this correction, I should say, in the market gave us really nice opportunity to get on board some good stocks at a discount. And that's in the live trading room. It's only offered there in the live trading room, but I do something similar with my trend trade letter and my exchange traded fund letter, ETF letter. So if you're interested in that and can't join me in the live room, go ahead and try those. All right. So here's the thing I wanted to look at. Scroll down. We had some data out this morning and it wasn't very good. Housing price index is actually housing price index went down on a city by city count basis. But if you take all the homes and average them all together, the prices actually went up. Just a tick higher, 4.6% on an annualized basis is what we were expecting, and we got 4.7%. Now, that's not good. That's why it's in red, because the market doesn't want to see inflation. None of us want to see inflation. Of course, homeowners are happy that home prices are going up, but home buyers are not. And right now, with mortgage rates high, home prices going up, inventory not real great. I mean, we live in Southwest Florida. Naples is our big city here. And the real estate agents, friends of mine, are saying that this is one of the worst years for inventory. They just can't find homes to sell. So that, of course, jacks up prices as well. So not good, right? That's not good. We don't want to see inflation. We don't want to see people not able to participate in a strong economy by buying a home. Consumer confidence also, boo, way down. Boo, big tank. 100.1, which is actually above expectations last month. Don't know why. Maybe everybody was buying ahead of Trump's tariffs. Plunged. The expectation was a plunge to 94, and instead we got 93. So not good, right? Not good. People are not buying things because they're worried that 25% tariffs or more on some key household goods, things coming out of China, technology and otherwise, clothes coming down from up from Mexico, and oil coming down from Canada. If those things get more expensive, everything gets more expensive, and that's why people are a bit um, worried about the future of their spending plan. New home sales also lower than expected. Now, what's coming up on down the pike here tomorrow? Big durable goods orders. So that's a very big read on uh, people spending money on big ticket items, right? Your appliances, furniture, I think furniture, cars, um, things that cost a lot and last long. Those are durable goods. I don't know what's exactly in that set altogether, but it's a very good read on the overall health of the consumer economy. And if that falls, and it probably will, just as it did last month, and it will probably do it again. In fact, they're expecting a negative 1.2. It may be even worse than that tomorrow. We get GDP, and it's just a third estimate. It's not an official form, but there have been so many big trading houses that have been out in the last few days, few weeks, calling for a negative GDP, really big negative numbers, right? Like negative 2.5, 3%. I don't know if that's going to happen. The market is expecting a positive number, 2.3. I don't think it's going to hit that. I think it's going to be 1.8, 1.9. Modest growth, but nothing like the scaremongering that we're seeing out of like JP Morgan and Morgan Stanley and the others that have said negative 2% or whatever. But anyway, that comes out. And we also get the chain deflator, which is an actual read on prices. So it's like an early look at inflation. If that comes in hot, then the market will not like that. We get continuing claims. Keep an eye on those. Continuing claims, I'm sorry, not continuing, jobless claims is one of the early reads on recession. So when you start to see those numbers tick higher, 250,000 is kind of a line in the sand. If anything below that is not too bad, right? Something the market can sustain. We start getting numbers above 250, 270, 280, 300. We know that trouble is on the horizon. So keep an eye on that. Don't think we're going to get much more than 225. They've been pretty tame. There's really no sign of recession in the labor market. We are starting to see signs of a recession on the productivity side of things in the manufacturing for sure. And just this morning, got a horrible number out of the services expectations, a survey out of the Philly Fed. Not good at all. It was really, really down there, the worst we've seen since COVID. So yeah, there are some signs out there that not all is good in Wonderland here. And then lastly, on Friday, we get the all-important PCE prices, which is supposedly speaking the Fed's favorite read on inflation. And this will probably be I don't know. I'm not going to speculate. I really don't know. We've seen the inflation numbers come in, like CPI, PPI, come in pretty tame. That helped spur this little rally we're experiencing now. PCE could be a different ball game altogether. We'll wait to see until we get there. Now, let's look at some charts, because I've got a map pretty well planned out, and I think I've got a binary map, so I'm bound to be right. It's market after April 2nd. So April 2nd is D-Day. Trump is calling it Liberation Day, which is, he can do whatever he wants. It's the day on which he announces in a definitive way, hopefully, exactly what the tariff structure looks like. Right now, it's just a guessing game. Market has already priced in a pretty bad reaction in the economy to tariffs. So market has been treating tariffs very seriously and taking very seriously the lack of forward guidance, because we just don't know exactly what the tariffs are going to look like when we get there. April 2nd, we should have some clarity. The market likes clarity. But if it is a clarity in the downward trend, which is to say, yeah, that we're not really back scaling on tariffs. We're going to do 25% here and 25% there, and and on all the countries that we've been talking about putting on tariffs. Yeah, I don't think the market's going to be real happy with that. The market rallied big yesterday on news that Trump was going to be more sector specific with his tariffs and not just broad range across all economies. That's a good thing. Market like that. But today the market's been a little bit squirrely because uh, is that all you got? And what's going to happen on the second? And Trump is not the best guy at staying on a consistent message. So we're just going to have to wait. My personal map is this: we get out to Friday this week, we get a little more upside, probably resolve upside today. It looks like we're kind of doing that already. And then we get PCE prices on Friday, probably going to cause a little bit of concern. Same with the GDP on Thursday. I think those two are going to give us a little bit of a pause. And then we've got Monday next week. That's the 31st. We've got Tuesday next week. That's the 1st. I think those are the 2 days that we'll see traders start to position ahead of the second. If they believe the second is going to be bad, they'll start selling and going short. If they believe the second is going to be a big backpedal, and I'm not sure I see that coming, but if they think it's a big backpedal, they'll start to buy up. So Monday, Tuesday next week, regardless of what happens this week, Monday, Tuesday next week will give us a pretty good sense for how the market is anticipating the big event. The big event. And I assume this is going to happen in the morning before the market. The big event on the April 2nd, Liberation Day. We'll see where it goes from there. Okay. So let's take a look at some charts. I've got right now the 3-hour chart on here, and I don't really want that. So let's go over to the daily chart, and we will start with some indexes. We could do the ETFs, but I like using the micro E-mini futures contracts because these will show us the intraday, the movement overnight. Don't get that in the ETFs. At least I can't figure out how to set TradingView to show me overnight data. But you do get that in the futures contracts, and so you're not going to see so many gaps. It's more of a smooth transition from one to the other. And here's the big 10% correction. This is in the S&P 500. We had a 10-11% correction from all-time highs to the lows in March, and then boom, 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 all the way up, back up above, which is good. Very positive. Back up above the 200 moving average, back up above the 21 EMA. You know the old adage, anything above the 21 is good things happen, below the 21 bad things happen, which is interesting to note because right on that day, that was the first major red stick below the 21, closed below the 21, and it was all downhill from there. So it's worth noting that we are now back above the 21. Moving averages have no magical powers, so we tend to think of them as lines of resistance when the price comes into them from below, and places of support, price comes down to them from above. That's not a bad thing, especially the 50 period and the 200 period. Those are typically places where you will see big managers, big fund managers have a lot of buy orders or sell orders, as it may be. So it's worth noting where those are, but they're not magnets and they're just lines on a chart. They're nothing in reality. What is more important is lines of support by price. So price will always trump moving averages. Moving average is just an average of price, but the actual price, where those pivot points are on the low side and on the high side, that's what you really want to note. So here we are at 58.20, and if we start drawing a line over tops and bottoms, we want to get as many of these in as we can. And I want to try to do this in a way that's fair. See this little nice 3-bar pivot right there, the clear line of support that held, and then it got broken. Line of support here, support here, support here, and then we have resistance. We have this whole area of resistance. And it's all kind of clustered around the same level. It's not a firm to the penny kind of level, but it is worth noting. Let me see if I can get most of this. it is worth noting that those areas have all kinds of price congestion in common. They've served as resistance, they've served as support. And guess where we are right now? Oh, yeah. Guess where we are right now? We are right there at that level on the S&P. Now, it's going to show you a little different on the spiders because not only is the futures contract, it just tends to trade at a little different caliber than the exchange traded fund. You're going to see that level a little bit higher on the spider. The spider level is 580. 580, where it's 575 right now. So we're only 5 points below, but that's still a little bit of upside left. Five handles of upside in the spiders that I think will probably close up by the time we get to PCE numbers on Friday. So I'm looking for a couple of days of just a couple of points each tomorrow and the next day, and maybe including a little bit today. Right, we're up 3.5 points right now. No, not on the spider. Sorry, we're up 60 cents on the spider. So if we add say $1.50 tomorrow and $1.50 on Thursday, we'll get there. We'll get pretty close to 580, and I think that's about as much upside as we'll get. So, do we want to go long the spiders right now? No, absolutely not, because the upside is limited on a risk to reward ratio and on a probability basis. Of course, it can sail right through 580, and it certainly will if Trump backpedals on the tariffs, or we get negotiating news, or we get all kinds of good stuff, which could very well happen, especially over the weekend, heading into April. But technically speaking, there is trouble ahead. Yeah. So here's the general rule, right? The general rule is that, and this is good to note. Let me see if I can draw this out somewhere. Hold on a minute. This is just technical analysis 101, and this is the same thing I'm going to tell you now is the very thing that I learned from the guy who mentored me in technical analysis. So you've got uptrend, right? Uptrend, higher high, higher low, higher high, higher low, higher high, higher low. And then suddenly you get a lower high and a lower low. Okay, so uptrend now is done, right? No more uptrend. See you later. Not necessarily that we're in a downtrend, because this could certainly morph into a trading range, however wide. It just goes up to the resistance, down to the support, up and down, and we go sideways for several months. And that's happened, in fact, for years at a time. Certainly possible here after hitting all-time highs with some uncertainty in the market. But once you get that break of the support line, which we had a few weeks ago rather, then you start looking for a sequence of, a little bit, sorry, a sequence of lower highs, lower lows, lower highs, lower lows, lower highs. And that's pretty much where we are. In fact, it didn't even look like this. It looked more like this. The little bit of, every other day, every 3 or 4 days, we had one bar of relief, and then right back down again. Then one bar of relief, right back down again. That's the kind of thing that we got. All right, so that's where we're at. And when that happens, right, broken support, lower highs, lower lows, we get that kind of pattern going, which is exactly where we're at. We have to be very, very suspect of any kind of a bounce, any kind of relief rally, which is now where we're at right now. Right now, we're in that relief rally. It's not a new uptrend. It's not the continuation of the bull market. It is a relief rally in a downtrending market. I mean, this is how I'm reading things. Yes, we are still in a long-term bull market. Yes, we're going to be great by the end of the year. 90% chance of that being certain. Yeah, the bull market probably has 3 or 4 years still ahead of us of good times. But on a trading basis, we are in a downtrend. We have to be suspect of any relief rally. We can trade the relief rallies, but we're better off trying to short them. Okay, so that's where we're at. Here is, here's your lower low, a little bit of a lower high, lower low, lower high, lower low, lower high, lower low, lower high. And then we had and have had several days of bouncing back on deep oversold technicals and deep bearish sentiment that lasted for a long time. We had 4 weeks of really, really deep bearish sentiment recorded in the AAPL sentiment reading. and all kinds of other things, right? Market internals were bad, breadth was bad, and yeah, it just was really nasty fall. So here's the thing: that kind of nastiness, that sort of bearishness, doesn't go away overnight. Um, our only hope, really, for a really good continuation of this run is for tariffs to come off. Number one, number two, in April we see some really good earnings. We need earnings because without earnings, of course, the economy is going to really start to. We're really going to start to second guess the economy. And last quarter, the corporate world was not giving us much in the way of forward guidance because of Trump and because of tariffs and all the unknowns. What we need now in April is for that forward guidance to come out. We really need to see that forward guidance come out. Right. That's why, without that forward guidance, we had all this muck, right? Pretty much downtrending, a little bit of up sideways, and then the big crack of the uptrend. We're going to get more of that unless we get some clarity from the big companies. All right, so that's where we're at. Here's the thing for next week. So I think a little bit more upside. This is the S&P, a little bit more upside. Are we going to test the 50-period moving average? I don't know. Maybe on the SPY, because that's 590. It's not. I don't think we're going to get to 590, not by April 2nd. But the S&P is a little bit closer. But I think it's this line right here that's going to be the decisive factor. So a little bit of upside into Friday. PCE prices come out. They might be a little bit scary. Even if they're not, we're going to start worrying about April 2nd. And then we have two choices. We either go back down and we test the recent lows if April 2nd brings us no change at all, or we go up and April 2nd comes along and boom, the market is really happy because Trump comes out and says, you know what, I negotiated with China, not 25%, only 10%. Canada's going to send troops to the border, get rid of fentanyl. Mexico is going to stop sending people over our borders and keep the drugs on their side. And Europe is finally bucking up. They're going to support NATO and pay us all kinds of money for goods. I don't know. I don't really see any of that happening that soon. But if that happens, then yeah, then we're right back to where we were 3, 4, 5 weeks ago, and we can all be really happy with that. Now, how do we play that? That's the trick, because we don't know ahead of time. So now, per technical analysis, we are at the peak end of a relief rally, and that generally means we don't short until we see. I mean, I've been playing some hedges, I have to admit. They haven't been doing real well, obviously, but we've been kind of nibbling on some hedges and beginning to build out at least a bearish posture in anticipation of what's coming down next week. But to be safer, then we need to really see a good rollover, good volume, and a taking out of the lows of the previous day. So today's lows are going to be pretty important for that. If we get a big red bar tomorrow on volume bigger than today, and that looks like that's going to be easy to do because it's another light volume day. Yesterday was really light, like 40% below average on the S&P. Today looks like it's even lighter than that, and it won't take much to start pushing the tape back down again. So, but we're not there yet. We would need to see a red bar tomorrow on volume, taking out today's lows. All right, let's take a look at the NASDAQ. It is similar, but I have to say that I'm not as impressed with the price movement here as I was with the S&P, and I'm not sure why. But I am sure why. The NASDAQ, of course, is dominated by the big mags at the top in a way that the S&P is not as much. And the S&P has all kinds of sectors besides tech that have been lifting it higher: insurance, gold, mining, stocks, shiny metals and stuff, materials, and some other things. Energy's been really good as well, although I think energy is about to fall, but energy has been really good. So all of those are helping prop up the S&P. We don't have those stocks in the NASDAQ 100, so that's why it's been a little bit weaker. We're not above the 200. We got stuck there this morning. We couldn't get past. We are above the 21. That's good. We actually nailed that yesterday. We're above yesterday's high. That's good, right? This is a continuation move. But volume has fallen off the roof, falling through the floor. And we've got overbought stochastics. And again, we are right at the top of the trend and the 200 period moving average. This has rollover written all over it, but it doesn't have to roll over. It can go sideways here, consolidate for a few days into April 2nd, and then if the news is good, we go up from there. All right, M2K. So this is the weakest link, has been for 2 years now, 2+ years. It was a strong and steady, right? 17 on a Heikin-Ashi basis, 17 red candlesticks in a row, which I have never seen. Never seen that in my 23 years of trading. Not that I'm out there counting candlesticks every day, but I just haven't seen that. 17 bars down, weak relief rally into the 21. We're just sitting on top of it today. It was a good day yesterday, I have to say, a very good day yesterday for the smalls. But no love for the smalls today, and it is not going to take much, right? Look at this tiny, tiny little volume. It's not going to take much to tip the Russell over and let it cascade right back down again. And you've got that downtrend. You know, the downtrend is just like I don't know how to describe it. If you've ever been kayaking on a rapid river and you're trying to go across the stream, you'll know that you're not actually going to go straight across. You're going to be going downstream with the current, right? Even though you are trying to get from one side to the other, you're going to end up 40, 50 yards further downstream because of the current. Well, that's the downtrend. It pushes against price. Not that there's anything magic about it. Price can do whatever it wants. Every day is a different day. It's all human psychology at play anyway. But the psychological aspect of the downtrend is that it works in your mind, right? Market's falling, market's falling, market's falling. Everybody's selling the rallies, and it just, and it just becomes a self-fulfilling prophecy, and that's exactly where we are. We have overbought stochastics. Stochastics can stay overbought for days on end. That's not necessarily a bad thing, but it is typically where you start to see the rollovers happen. RSI, not that great, but it hasn't been it hasn't been a very strong or a very big rally anyway. So no worries there. What gets me though is this tiny, look at this volume just dropping off. The same thing with the NASDAQ, right? At least, yeah, it has been just dropping off. Look at that. From the peak here on that very first up day to where we are now, lower. The same for the S&P. Yep, same for the S&P. Okay. So now I also know that this could be just a precursor to a big face ripper rally, and there are people out there, at least in my Twitter feed, calling for that. But we just have to be. I think we can be cautiously optimistic in the sense that we've stopped going down. That's really good. We didn't hit 20% bear market levels. That's good. We have stayed above. Well, I don't know. What have we stayed above? We haven't stayed above the 200, haven't stayed above the 50, haven't stayed above the linear regression channel. There's not a whole lot that we have stayed above, and a lot of support levels got cracked. But we'll just have to wait and see. So Bitcoin continues. Yesterday, very good day, has had a few days of goodness and love over the last this little relief rally. But again, everything is downtrending. The MA, the 21's below the 50. That's not where you want it. Long-term downtrend is still fine, still intact for Bitcoin. And I'm a long-term owner of Bitcoin, so I have no problem with this as an investment. But for a trade, I don't think you want to look on the long side. It gave us a nice little breakout yesterday above the 21, holding at the top of the range today, and we're still above that trend line. So all of those are positive. And the RSI also, you can see, broke out a few days ago down in this area, broke out to the upside. We have some IBIT in the wealth building portfolio, and it's been really, really performing nicely for us, even as the market has been a bit iffy. But just the way that this is set up, we'll just have to see. It's a hold. It's not an add, at least for me right now. Gold is just continuing to show some strength. It had a little bit of a pullback. It was a 5-day pullback on the miners. It was a 3-day pullback on the shiny metal. Now it's starting to get back up to the upside. Good to see the year yields come in, and that does look like a rejection of the 21. That would be good to see yields fall and bonds start to rally, because typically a really nasty bond market, which we've had for about 3 years, can weigh on on stocks. Why? Because it shows underneath the economy, you've got some distrust in corporations, lack of investment, lack of funding for capital expenditures. It all begins to trickle down when the bonds aren't doing that well. So, and also rising yields tend to make borrowing money a lot more expensive. That's also a drag on the economy. Frankly, I'm surprised that the economy has been doing as well as it has been, but a lot of that has to do, I'm afraid to say, with government spending. Last 4 years has seen, well, in Trump's first term as well, has seen a ton of extra government spending. Oh, before I forget, one thing I wanted to say. So we have a $6 trillion annual budget, but we only have revenues at $4 trillion. So we're deficit spending of $2 trillion. We've been worse, but really, we've been a lot worse. But the Trump plan, at least as I understand it, as it's been expressed by some of his finance guys, is that he wants to close that gap. He wants to do that by through tariffs, primarily through tariffs, and he wants to knock down the interest rate so that he can refinance at a lower rate. That saves a lot of money on the gap. He wants to spur businesses by lowering corporate tax rates, and that's going to cut back on revenue, but it's going to increase government spending. People are going to make more money. There's going to be more jobs. He wants to decrease your taxes, my taxes, personal taxes, income taxes, capital gains taxes. He wants to decrease those things so that we have more money to spend on stuff and invest. That pumps up the economy. So tariffs, lower taxes, deregulating the economy, he thinks is going to bring in a lot of extra revenue. We'll close that gap. Now, tariffs is the biggie. He wants to bring in, we're only bringing in about $50 billion in tariffs each year now, with the existing tariffs we've had in place for a long time. He wants to raise that to $500 billion. That's a 10 times increase on foreign products than we're now paying, 10 times. So I don't know. I don't know if that's going to happen. If we get anywhere near that, I think you're going to see some trouble. Either way, there's going to be some trouble. Okay, so that's all that. Let's take a look at some of the mags. And by the way, if you want to look at the whole set of mags and just kind of get a sense for how they are doing as a group, go to MAGS, ticker symbol. It is an ETF. And there's a leveraged version of this, MAGX, which I haven't yet played at all. And I'm kind of waiting for the mags to give us a better entry. But it's a good way of keeping track of the whole group. There are only 7, right? The 7 biggest companies on the planet are in that ETF. Bulls and Finga are also bullish ways of playing the MAG group, along with some of the other, like the 15 top stocks, not just the 7. So the little bit of a broader group. All right, the mags. Big sell-off, cracked the uptrend, right? After all these nice-looking breakouts, we never got a breakout, rolled over, lost the 21, lost the supporting trend line, held a little bit at the 200, and then we're down into the pink zone, and now the LRC is falling, the 21 is below the 50 is falling. All of this is downtrend 101. There are some good signs, however. We've got really good volume yesterday. We've got rising RSI, really the highest RSI since back up in this area. That's a good sign. Vertical stochastics. Now it is getting overbought, but at least shows the momentum here is very strong. Strong momentum is something to contend with. If this were just a tiny little weak relief rally, I think that we could be right in looking for a rollover in the whole group, the MAG group, coming soon. But that momentum and the volume and the strength of the indicators suggests to me that it's not going to go back down to the lows. It might consolidate. We might get a little back and fill, close the gap on April 2nd. But I think the map for the mags is something more like this rather than coming back down and testing the lows. So I don't think we're going to see that on the mags. So here's my thought. I think the indexes, especially the NASDAQ, which is broader based group of tech stocks, growth stocks, stocks without any earnings, stocks with just future growth potential, software names, cybersecurity names, a lot of these cloud names, AI names, they've all been under a lot of pressure. Semiconductors not doing very well today. And so I think you're going to see the NASDAQ be a lot weaker than the MAGs. If you're looking for kind of a safe haven in the volatility that's coming up in April, I think the MAG group might be a pretty good place. So I wouldn't go with bulls or FINGA. I would go with MAGS, or if you want some leverage, MAGX. Among the MAGs, let's take a look at the worst. Avgo Semiconductor, not good, but it's just down at the range lows. Should hold. NVIDIA is having trouble with 121. It was up there yesterday, came right back down again. It was up a few days ago at that level, 122. Couldn't hold it, couldn't come, it came right back down again. And same thing happened today. Now we are above the 21, but look how everything is just falling, right? Falling. NVIDIA has a lot of headwinds coming at it, and probably not the best place. I know we have some NVIDIA. We actually took our profits on that this morning, hit our profit stop, and it really crashed through it, and then rallied back up, and I think now it's kind of starting to fall back lower again. I like Cisco a lot. It's not real good today, but it is still in a nice uptrend. We're below the 21 and the 50, but we're building a nice little base down here in the rising pink zone of the LRC. That's a good place. Had a huge volume spike a couple of days ago, and that should be a green bar because that was an up day yesterday. Hasn't been doing a whole lot lately, but it hasn't been falling, so that's also good. Qualcomm is still holding really this nicely, it's around 150, 152, very strong sign of support. We're in Qualcomm in a diagonal spread. Microsoft, I just don't get it here. I'm not sure why it's not doing better, but this has been a very weak bounce. We're still well below that trend line. When it was inside in this little area here, it looked to me like it was really going to get going because it was holding all kinds of good support and a trend line, and it was getting tighter and tighter, and it's Microsoft. And then it just cracked with the rest of the market, came right back down again. Now, remember that at this stage, this was early to mid-February, the S&P and the NASDAQ are up here at all-time highs. Microsoft was not. It was a good 7-8% below those all-time highs, which were set back in June or July. So it hasn't been in good shape for some time. I would just avoid it for now. Facebook, strong, right? Bounce off the 200, uptrending LRC. Yeah, it's probably going to have a little bit of back and fill over the next few days. Not a buy here underneath that line of support, but it is one of the best looking mags, one of the best setups out there. Kind of like Amazon for the same reason. Still slightly uptrending, held the pink zone. Very good volume, like with the NASDAQ dropping off. This hasn't been dropping off. And we are following through on yesterday's big upside. I think Amazon is probably done for pulling back. I could be wrong, but I do think it looks that way. Tesla, I think Tesla's going to have another run to the downside. They're just a little too much coming at it from the front, and I like to see this. I like to see this recoil above the 21. Bit of follow through today. Hit the 200 period moving average. But you're still in a downtrend. You're still below the resistance trend line. That has to break first. If that breaks, closes back up above the 200. Breaks the trend line, shows me some good volume like we saw yesterday, really good volume. Remember the NASDAQ, right, down 30% off its average volume. Tesla was a good 40, 50% above average. So really good to see that. But I do think that, we have Tesla. I've been long Tesla for 7+ years. We're long Tesla in the wealth building portfolio, but just not feeling it as a new swing trade right here. Apple, Apple's showing me something here, which I didn't expect. because that was a very sharp drop, and then we had this really weak sideways churn in Apple, and it's been not real strong, like Microsoft, not real strong since it set its highs back in December. So this could just be a little weak bounce. Volume, it's hard to read that volume anyway. We do have an RSI crossover. We've got a fresh stochastic buy signal. So there are some good things going on. But again, I wouldn't buy the mags until after April 2nd. Let's get past that first. I like Google. We're long some calls in the options room. We bought yesterday, I think, or the day before. Anyway, very good volume. Pretty much of a flat trading range or linear channel. And we pushed nicely, confirming today back above the 21 period moving average. Yeah, it's not great. There's nothing really good out there among the mags, among the big stocks, except maybe Netflix. Yeah, Netflix looks pretty good, I have to say. This does look pretty good. This is the strongest FANG by far. So we're above all the moving averages. We're showing about a 3-week high right here. Volume has been good. Everything's moving higher. Yeah, Netflix is as good as it gets right here, as good as it gets. Okay, just a couple of ticker symbols that are looking pretty good. Let me see if I can find these now. We're long AON. It is a insurance play out of Ireland, I believe, and this is the kind of thing you want to see in a downtrending market. The market's come down 10%, 15% for the Nasdaq. This is down about 3 or 4% off of its all-time highs. Hitting the midline of the LRC, you've got the stacked MAs. Everything is pretty much rising. Volume has been a bit mixed, but that's the only negative I can see here. Fresh RSI buy signal, fresh stochastic buy signal, nice rounded bottom, pullback, and now back up above the 21. So that looks very good. If you're looking for a fresh, long shares to buy, I would recommend this one. And the other one that we're also in is Lifetime Health, which is a fitness chain. We used to be members when we lived in Fairfax, Virginia. Nice gym, very nice equipment. And big day yesterday. So we bought yesterday, some follow through today. Yeah, look at this big volume after earnings. That's always a good thing. You want to see that. It came down with the market, but not nearly as bad as the market. And it started rallying ahead of the market. All of those are good signs. It's a leader in the industry for sure. Breakout, follow through, confirmation. So you're going to look for this to get up to about 34, and who knows where it can go from there. All right, guys, I'm going to let you go. Sorry, I can't take chart requests today, just a little bit too long-winded. But if you have charts you'd like me to look at, go ahead and type the ticker symbols in the trading main room, and I'll post the charts there instead of doing them live. God bless everybody. See you back in the room in just a little bit. Bye for now.